Have you ever wondered what would happen to your investment portfolio if the market suddenly crashed? Would your carefully chosen ETFs weather the storm or crumble under pressure? In today's video, I'll be putting 3 of the most popular ETFs through the ultimate crash test, comparing QQQ, VOO, and SCHD to see how they truly perform when markets tank. By the end, I'll show you the surprising ETF that can protect your wealth during downturns while still delivering impressive long-term returns. The problem with market crashes. For most investors, market crashes represent their greatest fear. You spend years building wealth only to see your portfolio suddenly drop 20%, 30%, or even 50% in a matter of weeks. What's worse is that different investment vehicles respond very differently during these crisis periods. This creates a critical dilemma. Do you choose investments that perform best during bull markets, or do you prioritize protection during crashes? The recent April 2025 market correction, where the S&P 500 dropped around 20% and the Nasdaq fell about 25%, reminds us that volatility can strike at any time. Many investors assume that dividend ETFs like SCHD provide better downside protection than growth-focused options like QQQ, but the data might surprise you. Others believe that broad market funds like VOO offer the best balance, but is that really true? Today, we'll separate fact from fiction. The 3 contenders. Let's meet our 3 contenders. First, we have the Schwab US Dividend Equity ETF, SCHD. With $64.59 billion in assets under management, an expense ratio of just 0.06%, and a current dividend yield of 4.17%, SCHD has become a favorite among income investors. It tracks the Dow Jones US Dividend 100 Index and focuses on companies with strong dividend records and financial health. Next is the Vanguard S&P 500 ETF, VOO, a broad market index fund with a massive $541.45 billion in assets, an ultra-low expense ratio of 0.03%, and a dividend yield of 1.50%. VOO simply aims to track the performance of the S&P 500. Finally, there's the Invesco QQQ Trust, QQQ, which tracks the tech-heavy Nasdaq 100 Index. With $268.68 billion under management, an expense ratio of 0.20%, and a yield of just 0.71%, QQQ is primarily focused on growth rather than income. Historical crash performance. Now, let's analyze how these ETFs performed during major market crashes over the past 25 years. Dot-com crash. First up is the infamous dot-com crash from 2000 to 2002, where the S&P 500 declined 49.1% and the Nasdaq plummeted a staggering 77.9%. QQ, being heavily weighted toward technology, was absolutely devastated during this period with a maximum drawdown of 83%. Even more shocking was its recovery time. It took QQQ more than 14 years to get back to its pre-crash levels. That's right. If Harry invested in QQQ at its peak in 2000, he wouldn't have broken even until 2014. VOO's predecessor index fell about 49%, roughly matching the broader market as expected. SCHD didn't exist during this period, so we don't have direct comparison data. Global financial crisis. During the 2008-2009 financial crisis, the S&P 500 dropped 56.8%. QQQ experienced a 51.5% drawdown and took 23 months to recover. VOO, tracking the S&P 500, fell 55.3% and required 51 months, over 4 years, to return to previous levels. Again, SCHD wasn't around yet, but dividend-focused strategies generally performed somewhat better than the broader market during this period. COVID-19 crash. The COVID-19 crash in early 2020 was both severe and remarkably brief. QQQ dropped 28.0% and recovered in just 4 months. VOO declined 35.0% and took 5 months to recover. SCHD fell 37.7% and took 13 months to fully recover, significantly longer than the other 2 ETFs. This is our first interesting finding. During the COVID crash, SCHD actually experienced a larger drawdown than QQQ and took much longer to recover. This contradicts the common belief that dividend stocks always provide better downside protection. 2022 growth stock correction. The 2022 market correction hit growth stocks particularly hard. QQQ plummeted 39.7% from December 2021 to December 2022 and took 12 months to recover. VOO declined 25.7% and took 15 months to recover. SCHD fell just 16.2% and recovered in a mere 7 months. Here, SCHD clearly demonstrated superior downside protection with a much smaller drawdown and faster recovery compared to both QQQ and VOO. April 2025 crash. Most recently, in April 2025, we experienced a tariff-induced market correction. QQQ dropped 14.0% with a projected recovery time of 8-12 months. VOO declined 12.0% with an expected recovery of 6-10 months. SCHD fell only 7.0% and is projected to recover in just 4-6 months. Again, SCHD is showing remarkable resilience compared to the other ETFs. Analyzing recovery patterns. Now let's look deeper at how these ETFs behave during recovery periods after market bottoms. After the financial crisis bottom in 2009, QQQ gained 58.3% in the first year and 98.7% over 3 years. VOO gained 46.9% in the first year and 84.1% over 3 years. After the COVID-19 bottom in March 2020, QQQ surged 87.5% in the first year. VOO rose 74.8% in the first year. SCHD increased 64.3% in the first year. After the 2022 growth correction bottom, QQ jumped 54.1% in the following year. VOO gained 37.4% in the same period. SCHD rose a more modest 19.7%. This reveals an important pattern. While SCHD often provides better downside protection during crashes, it typically lags during the recovery phase. QQQ, despite suffering deeper drawdowns, usually leads the recovery with the strongest percentage gains. What's fascinating is how this translates to actual recovery time. Despite experiencing larger percentage drops, QQQ sometimes recovers to previous price levels faster than SCHD because its recovery gains are so much stronger. Portfolio construction strategy. Based on these findings, let's develop a strategic approach to building a crash-resistant portfolio. Sector analysis. First, let's look at what's inside each ETF. SCHD has significant allocations to consumer non-durables, 17.34%, health technology, 15.94%, energy minerals, 14.34%, electronic technology, 11.64%, finance, 8.18%. This diverse sector allocation helps explain SCHD's resilience during certain types of market corrections. VOO broadly tracks the U.S. market with information technology, 30.7%, financials, 14.5%, healthcare, 10.8%, consumer discretionary, 10.5%. QQQ is heavily weighted toward technology services, 32.31%, electronic technology, 29.57%, retail trade, 11.35%, health technology, 5.95%. Understanding these sector allocations helps explain performance differences during various market environments. Strategic allocation. For most investors, I recommend a strategic allocation across these ETFs rather than choosing just one. Here's why. 1. QQQ offers the strongest recovery gains and long-term growth potential, but comes with the deepest drawdowns during market crashes. 2. SCHD provides superior downside protection in most market corrections and delivers steady income throughout market cycles. 3. VOO delivers balanced performance that falls between the other two in most metrics, making it a solid core holding. A balanced approach might include 40-50% in VOO as your core market exposure, 30-40% in SCHD for downside protection and income, 10-20% in QQQ for enhanced growth potential. This combination offers meaningful downside protection while still capturing substantial upside during recovery periods. Financial projections. Let's see how a $10,000 investment in each ETF would have performed over different time periods, including through various market crashes. 5-year performance, including COVID and 2022 corrections. If Harry invested $10,000 in each ETF 5 years ago, QQQ would have grown to approximately $17,800, 12.2% annualized return. VOO would have grown to approximately $15,600, 9.5% annualized return. SCHD would have grown to approximately $16,000, 10.4% annualized return. 10-year performance, including financial crisis recovery. Over a 10-year period, QQ would have grown to approximately $39,500, 14.7% annualized return. VOO would have grown to approximately $29,300, 11.3% annualized return. SCHD would have grown to approximately $30,800, 11.9% annualized return. 30-year projection with average crash cycles. Projecting forward for 30 years with typical market crash cycles, $10,000 in QQQ might grow to approximately $424,000, 13.5% annualized return. $10,000 in VOO might grow to approximately $174,000, 10.2% annualized return. $10,000 in SCHD might grow to approximately $192,000, 10.7% annualized return. What if Harry used a crash-optimized strategy? What if Harry invested $10,000 using our balanced approach and then strategically rotated a portion of his assets based on crash signals? By moving 20% from VOO to SCHD during market stress periods, and then shifting that allocation to QQQ during early recovery phases, Harry could potentially enhance returns by an additional 1–2% annually. Over 30 years, this could result in a final portfolio value approximately 30–40% higher than a static allocation. This crash rotation strategy takes advantage of the unique strengths of each ETF during different market phases. Conclusion and recommendations. After conducting this comprehensive crash test of QQQ, VOO, and SCHD, several key takeaways emerge. 1. No single ETF is superior in all market conditions. Each has distinct advantages during different phases of market cycles. 2. SCHD typically provides the best downside protection during market corrections, especially those not specifically targeting dividend sectors. 3. QQQ often experiences the largest drawdowns but delivers the strongest recovery gains. 4. VOO offers middle ground performance in both crashes and recoveries. 5. A strategically allocated portfolio across all 3 ETFs, with tactical adjustments during market transitions, can optimize both protection and growth. For investors prioritizing crash resistance, SCHD has proven to be remarkably resilient, particularly during the 2022 correction and the recent April 2025 tariff-induced market decline. Its sector diversity and focus on companies with strong financial health contribute significantly to this protection. So, which ETF is right for you? If you have a long-time horizon and can tolerate volatility, a higher allocation to QQQ might be appropriate. If you're near retirement or highly risk-averse, SCHD deserves a prominent place in your portfolio. For most investors, a balanced approach with tactical adjustments offers the best of all worlds. What's your experience with these ETFs during market downturns? Let me know in the comments below. If you found this analysis helpful, please hit the like button and subscribe for more data-driven investment insights. Thanks for watching.